Welcome to the Investors Podcast. I'm your host, Trey Lockerbie, and today I'm super excited to have on the show Howard Lindzon. Welcome to the show, Howard.
What's happening?
First of all, I'm really excited to speak with you because I don't think I've ever interviewed anyone who has been a hedge fund manager, an entrepreneur, multiple businesses. Some of them have exited, an angel investor, a VC. I mean, you've literally sat on all sides of the table, not even across the table. I mean, literally all sides of this probably round table that we're referring to. Of all of those experiences, I'm curious, which role have you enjoyed the most?
It's a good question. Thanks for having me on. I think the role that I have the most, because it happens so infrequently, but I've probably written a couple hundred checks into founders, but just those few that I've known, as soon as I wrote the check, I was going to make a lot of money. Whether the founder believed it or not, I knew enough about the industry or what I wanted to see in the world that the investors presenting to me, like I knew they were going to be billion-dollar companies. So I think that's, as a non-talented person myself, non-talented operator / can't play sports, I don't know really much. Sitting across the table and seeing like someone present you something that you know is going to work is pretty cool. And then seeing it happen, obviously.
That's actually really interesting. So is there something, maybe a common denominator between these founders that you see? Is it just a certain level of grit or just energy level of intelligence? What kind of stands out to you the most?
So I've had good mentors, but yeah, I who have seen the goal line themselves. It's kind of I do a lot of sports analogies, but generally it's a founder that has unbelievable, they get the timing right, they get the platform right, they get the idea. It's like so many things that they don't even know it, because sometimes they don't know the industry that well, but a few examples are LifeLock, which was an identity theft insurance company. Todd Davis, when he pitched it to me back in 2006, I was like, as soon as he pitched it, I knew it was going to be like a home run idea. And there was all kinds of headaches along the way to a multi-billion-dollar company, but just the general kernel of the idea that, was a home run. Same with Robinhood, same with eToro, same with a few that I've passed on, Carta, Twitter, but the ones that I've gotten right on and the ones that I should have done all had this very simple product market fit idea, and it was at the right place at the right time with the right founder, and that helps a lot. That kind of impact right at the beginning, when all those forces come together, can create some kind of explosion that you can get a lot wrong and still build a huge company. The day-to-day grind of building it yourself, let somebody else do it. What a headache.
I can relate to that. Yeah. So it sounds like this sort of a Venn diagram where all these things kind of merge and right into the middle. Very interesting. I'm curious on that point. Have you ever felt that feeling and then it not work out? You're so convinced, hey, this is a sure bet, and then it just didn't pan out either due to timing or something else.
Yeah. I mean, there's a couple TBDs. I'd say the one that there's a lot of deals in the last 5-6 years that have been screwed up out of SoftBank. They got too much money. They went too fast. You had everything right, except you didn't take your time, right? The art of startups is, the pace. And there's been this period the last 6-7 years. It's ended, I guess, over the last 6 months. But finally, for good and for bad, there was this pace of capital that was getting thrown at these ideas that seemed like they were working, but a lot of money thrown at a business that's not quite fully tuned have been the ones that I'm these guys, it reminds you that too much money can destroy things. So this company that we invested in called WAG, which we were the seed investors out of LA, as a dog walk. It's kind of Uber for dog walking. And it was no brainer. Everybody wants to walk dogs. Families have 2 working parents. really good founders. Everything was lined up perfectly, and it was working very well. And then SoftBank came in and put 600 million in like the third year of business. I'm like, what could go wrong? Well, some businesses just aren't meant to be Uber. So I would say a lot of my disappointments, and they're very limited, because once an idea is working, it's really hard to screw it up, especially in the era of the cloud, where you can just hook up to AWS. You can use all these enterprise software products, and you know how you can hire recruiters and you can staff up really fast. So it's really hard to screw up a good business. But we're seeing here in 2022 that too much money can screw up a lot of businesses.
Well, I know that one of your operating beliefs is that the stock market is rigged. And I think a lot of market participants these days would agree with you, given all this attention around the Fed, for example. That said, you've had this belief since you were starting out in the markets. I'm curious how the markets were rigged back then, and how does it compare to today?
Yeah. So part of my thesis around the markets are rigged is if you come into everybody, especially in this Robinhood era or the crypto era where everybody gets to be Goldman Sachs. Well, we've learned that it's not that easy to be Goldman Sachs, not that easy to be a crook, let alone an honest businessman. But the idea of it being rigged is, in the 90s when I started out, before Reddit and Twitter and StockTwits and the internet, for that matter, YouTube and TikTok, quotes were delayed 20 minutes. So in our first go around of E-Trade and our first go around of Robinhood and Reddit, there was Yahoo Finance and there was E-Trade. And us Yahoo financiers were looking up stock quotes and placing trades on 20 minutes delayed data. So if you can imagine that today, imagine like seeing a quote on Yahoo, buying the stock, and it's from 20 minutes delayed data. And we were thrilled. We thought, woo, we are YOLOing to the moon. That was what YOLOing to the moon meant in 1998, 1999. These kids today, they don't understand what their internet's. And there was no mobile phones. There was no smartphones. We were just dumb idiots. But it just felt like we were close. That's how far away. There were institutions and there were newspapers, and then there were the retail idiots like myself on Yahoo Finance. So, come on, the market was rigged. We didn't have the data. Alan Greenspan used to come on. They used to have a whole day dedicated to Alan Greenspan where they had pictures of his briefcase and they were trying to figure out what was in his briefcase. Now, it's not even everybody knows everything in real time. Everybody can trade for free. And now the Gen Zers think the market's rigged against them. Well, let me just, explain to people the market is rigged. And if you invest with that in mind, knowing that you're the last guy to know and that you're paying the highest price, that'll make your investing, you'll start out with a less of an aggravated mind, meaning, invest accordingly. Like assume that Warren Buffett and Goldman Sachs know more than you. Assume that no matter how many great tools you have or how good your network is, there's people more in the know, and invest accordingly. Because if you get upset about the whole thing, you'll just go down a rabbit hole of you'll end up saying the earth is flat. And that's not a good rabbit hole to go down to. So much like any kind of sport, the sport of investing requires you to understand how the playing field is set, and bringing the fees down to zero, fantastic. Bringing close to zero, bringing Twitter and Reddit and StockTwits real-time information, social networks, fantastic. But the game is just as hard because everybody has the same tools, and so invest according to that, and I think you'll enjoy it more. But you're not going to get rich overnight, and we all thought that in 98. 99, and then the people started thinking that during COVID, and here we are in 2022, and everybody's upset. Well, it's the same thing over and over, just with new technology.
I love this because, you did mention Buffett there. He's got that quote about if you can't, you're sitting at a poker table, if you can't figure out who the patsy is in the first 5 minutes, and then you're the patsy. And what you're saying is hey, we're the patsy. We know it. And you're owning it. And yeah, I know that you look at investing also like a game. I'm kind of curious how you would exactly define investing as a game. Is it just simply betting on probabilities is there something else to it? And how did you kind of own the patsiness of your investing strategy?
Well, you have to own the patsiness. So right there, you got to be able to laugh. CNBC was always you got to have an arch enemy. First of all, if you're going to start a business, it helps to have an enemy made up or real. My enemy was always Wall Street Journal and CNBC. They were easy enemies because they're evil. They call it entertainment, but it's not entertainment. It's misdirection. Everybody has, and this goes to my, everything's rigged. Why are they talking about why they are talking about it? Someone produced the show. Someone whispered in someone's ear that this is a good topic. Something bubbled up to the top. And then, the machine gets going, as is media. And so the game for me was, when I was a kid, we played a game called Risk. It was a flat board game, and it was about world domination. And what was great about Risk is every game was, once you played enough, there was some chance, obviously, a roll of the dice. And the same thing goes in the markets. There's probabilities, and you got to stack the odds in your favor. But how you started the game and where you started the game and how you moved to take over the world was very much like, you could see people's different risk profiles and strategies based on how they played this board game pre-internet, pre-anything. You'd sit around for 6 hours, and they spoofed it in Seinfeld for a while with Kramer, and they had this, and Newman had this hilarious board game where, they had to have people watching the board. But we would play these games, and depending on where you started, if you started in the middle of Europe, you were doomed because you had to protect all these borders. Everybody's fighting for Europe. But if you started in Eastern Indonesia, and that's the same thing with startups, if you start doing one thing really, really well and kind of polish it and hone it and build up your armies, then you can move up into India through Siam, and then you can kind of spread out that way, and you're protecting less borders. So, the whole point of investing in business is, and this is where too much money came into everything. Everybody was starting with global domination 3-4 years ago because of all the money. And Uber was and Airbnb were the examples. If they had a kernel of growth, you threw a lot of money on it, and it became, let's go to China, let's go to Europe, let's just win, win, win. And if we flash forward to 2022 and NFTs and crypto, it's back to the art of building a business, which is how small can you be? How small can the team be? How fast can you, polish it and then kind of, go out into the world with an idea? There's some sort of art to that. And so that's how I feel like it's a game. And there's many ways to play the game, but with investing, you also have to stack the probabilities, right? You can't just, every trade can't be the same size. Every trade can't have the same risk return profile. But if you're disciplined, you can try and find trades or investments that line up in your favor, like a 3 to 4 to 1 upside. And so if you really are patient, which is hard to do, and disciplined, you can line up higher probability investments. And that's kind of the only way to get ahead. And then it's constantly like stacking and filling. If you build your own business, still the greatest way to wealth. But if you're trying to become a billionaire just from the stock market, I don't know what book you read or who's lying to you, but that's just not what it is. The stock market is for growing your wealth and preserving your wealth and compounding your wealth. But in terms of like building your wealth, pre-internet, we were told that like a hedge fund was how you did that, which is why I started a hedge fund. And the reason a hedge fund theoretically could work is because you're getting paid fees whether you beat the market or not. So it really was an interesting model, but a completely unfulfilling way to make a living. But if you're just trying to make money in the market for yourself, very hard to do. And so a lot of people have come into this market recently thinking they can just get rich in the market, and we're learning that that's just not possible.
You mentioned the hedge fund there. I'd like to go there next. You said it's unfulfilling, and yet you did it for 18 years. So I'm kind of curious about that experience and how it kind of led to all these others that we're going to talk about. I'm curious about, taking that mindset of being the patsy and then going into the hedge fund world. Was that in a way to obviously increase the odds in your favor? Were you using kind of retail-esque strategies early on and it change over time? Maybe walk us through the strategy and the thesis for starting the hedge fund.
Yeah, well, it was probably closer to like 8 years. The fund still exists because I made a lot of investments in private markets that continue on today. So it's still kind of an entity. But I was smart enough after 8 years to go, I give up. I threw up my hands and I was like, there's no way to beat the market. So in 96, 97, as the internet was just starting, pre-internet, pre-cloud, basically you opened a store. There was more, you could be an expert or you could fake being an expert because there wasn't that dissemination of information. And so being an entrepreneur around the stock market was starting a hedge fund. You could be a stockbroker and, invest like that, or you could start a hedge fund, which was more of an entrepreneurial way. It was like convince a lot of your wealthy people around you to invest and take a fee. What I learned very quickly was I didn't know what I was doing. I wasn't doing anything wrong. It was just that, Vanguard came along and you could realize no matter what you did, it was very hard to beat the market. And so in 2005 is when I started to make some private investments. So the way it worked was I knew, and a lot of this goes to Warren Buffett too, that you couldn't beat the machine, right? Like Vanguard was this great, simple, disciplined kind of momentum, market beating strategy. It really was the market. And once you started competing against that machine, by 2005, I was like, what am I doing? Like, this is just, if people want, and I say this today, if people want market returns, they should invest in the market. That was the beauty of Vanguard. 8 to 12% a year, certain amount of drawdown over time. But historically, that is market returns. If you think you can beat that, and we all try at some point in our life, you may be able to beat it for a while. And the latest version is Cathie Wood. And when I was growing up, it was Garrett Von Wagner and Peter Lynch. There are a few people that do beat it, right? Just like there's a few athletes like Tom Brady who defy all the odds. But it's not a good strategy to bat your head against the wall and think you can beat everybody. And the market you're competing against globally, 24/7, 365. There's no like season off. So the market is like grueling, like no other kind of sport or game, in that you're competing against everybody in a multiplayer game 24/7, 365. And then they're constantly throwing twists. Now it's crypto. So now you got like a whole nother asset class that you got to learn and all the correlations between them. So, forget about it. I've long since said that if you want stock market returns, you try and be in the market and manage your expectations to those market returns. Venture capital became exciting to me because there was no index, right? And it felt like you had an edge because you had some domain experience. And I liked the idea that I couldn't see the price of my portfolio every day. And we're seeing that now with crypto. Seeing the price of your portfolio really messes with your mentality, because it affects your mood and it affects how much risk you want to take. And it makes you do the wrong things at the wrong time. And so for me, investing in startups 2005 and onward, it allowed me to be a better investor because I wasn't worried about the day-to-day and month-to-month fluctuations. Every company has these incredible gyrations, whether it's from bad hires or missed launches. And if you're a public company and you're marking yourself to market every day, you're going to end up zigging when you should zag way too many times. And, the private markets kind of smooth out those type of mistakes. It's not perfect, but I felt like it truly gave me an edge. And that was when I started doing that full time.
You mentioned Peter Lynch there. I kind of want to start there. So as I understand it, you made an Apple investment very early on that you've held on to your credit, but you came about it in a very Peter Lynch kind of way. I'm wondering if all of your best investments kind of came from that, scuttlebutt approach, if you will, or, and is that kind of golf swing, if you will, or I can't think of a better analogy, but sort of your style that's worked out best.
Yeah, Peter Lynch, there's been a few books that have really, even though they're not necessarily stock market books, and I'm not a big book reader in the world of the internet. I never really had the concentration to read books. But Peter Lynch's Went Up on Wall Street and The Tipping Point, which was not a stock market book, but it was basically a a book about tipping points based on like what happened in Soho. And I was a big Soho guy. Like I loved hanging out in Soho and shopping in stores in mid 2000s when I was building Wall Street. And so I really kind of believe that you can immerse yourself in these trends. And when I stumbled into first of all, I was lucky. Apple's, at the time that Apple first started launching stores, that was considered a joke, right? There had been Gateway stores and Dell stores, and there continually been flubs like computer hardware at retail. And so it was like, I'd written off before it started that Apple opening Apple stores would be a disaster. And I wasn't even thinking about it as an investment, but where I worked in Phoenix at Camelback and 24th Street happened to be one of the first Apple stores. It was a high-end neighborhood, office neighborhood. And for whatever reason, and I wasn't even an Apple user. This is 2002. At the time, to run a hedge fund business, you were using Windows. Like there was no internet software to run your trading programs, and all the banks were hooked up to like proprietary software. So you didn't use the internet, you didn't use Google Chrome, you didn't use Safari. So I was not an Apple user, obviously. And I went over to the Apple store, and the iPod was there, and it was really well done in the way that you cocould take it, and like it wasn't like you didn't have to put it behind a glass that everybody was doing. And I bought my first Apple product, which was an iPod, and I put the earbuds in, and I was like, everybody's going to have this, and I just had one of those moments, and it just kept self-reinforcing. The more you saw the white earbuds and the AirPods, the more bullish I became. And the fact is, I was becoming an Apple user for the very first time, even though I was in my 40s. So it just dawned on me that the market was massive, and that the stores, if they could execute, obviously a lot of risk, was going to be a home run. I thought there could be thousands of stores. And here we are today where they've executed beyond all those things. But that was just stumbling and bumbling into Apple. So yes, all my best investments have come from me kind of Larry Daviding Curb Your Enthusiasm, a modern version of like, Peter Lynch, which is like a little bit more like self-aware, a little bit more anything's possible, and a little more like, now that I've seen it happen in my life, I'm kind of looking for it, for those aha moments where my own experiences interact with trends. It gets harder as you get older, because now I'm 56 and I have different interests than a 30-year-old, meaning TikTok, like I didn't see it because I didn't use it. Tesla, I didn't see it because I wasn't a Tesla customer. So a lot of it is it's much easier if you're the customer and you're in a demographic that is so big that it's like impossible to ignore. So it's very hard to do over and over again, because you get older and the context of which you see trend changes.
Let's talk about that demographic that's so big you can't ignore. You have this 8 and 80 rule. And originally I thought this to mean, invest in small caps that become large caps, like a 10 bagger, as Lynch would say. But you're actually speaking about products and markets. Walk us through this 8 and 80 rule and how you arrived at it.
Yeah, I'm not very good at marketing, but the concept about 10 years ago was that, if you're going to buy growth companies, or especially once the internet came along, you want to try and find these markets that have 8-year-olds and 80-year-olds using it. And at some point, really, it's 2-year-olds and 102 years old. Like if Google has something for the masses, for anybody between 2 and 102, you see a 2-year-old, 4-year-old with an iPad, they're scrolling on YouTube. You see an 80-year-old, they got an iPad and they're using Gmail, or they're, so Apple and Google really kind of are those 8 to 80 brands that really, 8 to 80 theoretically could be Exxon. Don't get me wrong. Like a 5-year-old knows what Exxon is, and a 100-year-old knows what Exxon is. But so you can prepackage, it's not a perfect thing, but I try and find companies that have these massive demographics working in their favor. And that just helps. Like if you're not trying to beat the market, at least, or if you want to be trying to beat the market, I apologize. If you're trying to beat the market, try and go with companies that have massive, massive markets, and they're not subject to the same cyclicalities as other people. And so it's just something that, like a little gimmick that I try and categorize companies that I'm looking at and want to own. And then there's obviously risk management around that. And I have this other term called fashology, where if you look at today in a world of technology, LVMH is one of the biggest companies in the world, and Nike. Are they technology companies or are they fashion companies? So I think as technology continues to permeate everything, I think fashion and technology meld, and some of the, and if not the biggest companies in the world will be companies that do that well. Motorola was a great company, but you weren't going to buy Motorola sunglasses. I mean, they tried, they had partnered with Oakley, but and you're not going to buy Apple sunglasses, but you would buy Louis Vuitton sunglasses powered by Apple, And so there's all these different meldings that are going to happen now that technology permeates.
So we talked about how you held Apple for a very long time. There's this quote that I love about, how'd you get wealthy? Well, by selling too early. And so I kind of brings to mind any positions where you sold too early and watched something run on much farther than you thought.
Yeah, pretty much everything. I try not to get mad anymore because my mentors are the same way, Fred Wilson, Brad Feld. Like, you can't, if you're not running the company, and it becomes too much of your portfolio, it almost becomes not, and you're not managing other people's money, it becomes almost irresponsible for you to have too much in one position. And it happens to me all the time, whether I invest a little bit in crypto and it becomes a huge part of my portfolio, or Robinhood, which then becomes a huge part of your portfolio, and it stresses you out, and you're not going to call the CEO every minute because you can't. So, I generally am pretty disciplined about selling. Apple, obviously, if I had bought shares every time I sold a little bit to think that I was like diversifying, I'd be a lot wealthier than today. The odds of staying, if I could have predicted the iPhone and services and the AirPods, and, I couldn't. So along the way, risk management, unfortunately, has forced me to sell my winners down. And those have been mistakes. But that is investing. The most important thing for investors to know, because we're not competing against anybody, right? When you watch an investing show, or you're online, or you're on FinTwit, everybody's competing. My portfolio is better than yours. I'm making more money than you. I don't even know what that means. Like, you're supposed to invest for the joy of investing and the art of trying to compound capital. And so everybody has different time horizons. Everybody has different risk profiles. So I think people need to get in the habit of managing to their own risk. And that involves selling some things early, and that involves diversification. And you're going to make mistakes. I just have a good ability to move on. And maybe that's not a good ability. Maybe that's why I'm not a billionaire. But I also have my sanity.
And you could sleep well at night. I'm curious how you define risk. Say a position has gotten so big in your portfolio, you don't really have a thesis that the company is going to do anything to not keep growing, but it's just a position thing. Is it just the sheer volatility that's coming into play, or the potential of loss? Walk us through how you think through risk.
Yeah, there's been a couple recently, and it's an investor in a fund called Multicoin, and they had a big position in Solana, and it worked in my favor because I couldn't sell. And so for a couple of years, I know if I had owned the position myself, I would have sold so much earlier, for whatever reason, mainly because I didn't understand it. I wasn't a user of the product, but the fund that I invested in just held it. And, so at some point last year, I couldn't sleep. I was like, what? This is silly. Like, I'm excited. I'm too excited. And I sold enough that would let me feel not like an idiot if it went to zero. I will tell you that that's never enough when it does go down 90%. Now I feel like I should have sold more. So it just has to be a consistent being honest with yourself. And I found that writing every day and journaling helps me stay accountable to how I'm feeling about these things. If I'm too excited, it shows up in my writing, and that's a good time to sell. And if I'm too miserable in my writing, it's a reminder maybe I should be buying something. And so that discipline of writing it down and journaling has really helped me kind of trim. In the end, it's not a perfect thing. You're gardening at the main time, and sometimes you sell too much, and sometimes you won't sell enough. But I think the art of consistently doing the right thing, like gardening your portfolio, is going to pay dividends. Are you better off at the beginning of this bear market than you were at the beginning of the last bear market? And that's the game. Like you stack your chips, you move forward. You know that you're not going to perfectly time getting all your chips off the table, but what can you live with if the market were to change completely tomorrow? And I think if you asked a lot of people now, like, hey, in March 2021, when everybody was doing SPACs, guilty as charged myself, and crypto was going to the moon, and Solana summer, and Tesla was going to the moon, and Dogecoin. If you look back and said, listen, and I had these conversations with a lot of smart investors that were like, I don't want to sell. I'm going to owe 30% in taxes. And, if I sell it at 200, it's really like selling it at 140. And I would say, yeah, but you own it at like 10. But, you can only try and talk to people. And now it's at 50 or 40. And that $90 spread of where they would have paid tax. So you have to, like, when it gets so good that you're not selling for taxes, that's generally a good sign that you should be selling. Because so there's no perfect rule, but I think people have to be honest with themselves about how they would feel if the stock did this. And generally, they can't see that. They can't see something dropping 70% for no reason. Well, here we are, and it's happened to like 80% of the tech stocks. So, and no one can explain why. And guess what they're blaming? They're blaming Biden, and they're blaming the Fed. I'm like, why are you blaming one guy for an 80% drop in your portfolio? That's just crazy. But that's what people do. That's why presidents get voted out for the economy, is that reason.
I love this so much because the way I'm interpreting it is, some people have these very rule-based approaches to selling. They'll have a checklist. They'll say, hey, the missed earnings, that they're doing X, Y, Z. And I've just never felt like that was the thing for me or the approach for me. And what you just described is way more qualitative. I love the idea.
It's very qualitative.
Journaling and saying, I'm too happy as I'm writing. Such an amazing way or framework that I can totally relate to, because that's essentially how I operate as well.
Yeah. Well, or you could drive yourself insane. But if you think you're a quant, I'll introduce you to a few quants. Okay. So you have a lot better chance being the Larry David of investing, or the Peter of being a qualitative investor, than you do of being a quantitative investor, because all the smartest people in the world have gone into quant, because it's mathematically based model. And if you think you can be as iron cold as a machine, I'm going to tell you, you're not. And they're going 24/7, 365. They're constantly learning. So qualitative is your edge. Putting time on your side is your edge. And domain experience is your edge, and your network is your edge. So these are the things in a world dominated by quants and AI, the edges are still qualitative.
I'd like to talk about your experience with Amazon as well, only because, I know you've held that for a long time. That was one of those bulls that was bucking nonstop the entire ride, it would seem, and you've held on for quite a while. What I'm curious about most, I guess, with that is the optionality you saw early on, meaning they did what you said on the risk board. They were starting in a very specific part of the world. They weren't boiling the ocean. They were selling books. At what point did you get in, and what were you seeing along the way as far as the optionality there?
I didn't get in until I started my show, Wall Strip. I didn't know what AWS was even. 2006, when I started Wall Strip, I was doing one of my shows, and we were talking to a friend, forget his name. He had started a music company, like a database company. And we were interviewing him. He was talking about AWS and how it was started by Amazon, and they're powering all these startups. And I'm like, if you sell picks and shovels to startups, that's a good business, especially as Web 2 was going around. And then my daughter was using the Kindle. So it really wasn't about e-commerce when I invested. It was really about AWS. And hearing their name over and over as a startup guy myself, an angel investor, and starting StockTwits, so we were all hooking everything up to AWS. We didn't have to buy computers. We were just outsourcing all that to the cloud. It was like a no-brainer. Like projecting my business across millions of businesses, I felt like I had inside information. And so it really wasn't about e-commerce at all. Never, still isn't. It's still been about AWS. And obviously now it's different because people have choices between Azure, they have DigitalOcean, they have Google Cloud. So Amazon, you've got a lot of competition. It's not, now they're a FANG stock and everybody loves them, and I still own a lot, but it's not like I'm as excited about it as I was in 2008. 2008 felt like the Apple AirPods. It felt like I knew something that everybody was going to know. And I knew it because, not that I had inside information, but I was talking to hundreds of startups that were all hooking up to AWS, and everybody was talking about Amazon as a bookseller.
Another company where I feel like you knew something other people didn't was Robinhood. And you say you're a trend follower. I mean, I think that's related to more of the stock, but I'm curious, when investing in private companies like Robinhood, way before people even know what it is, what it was, what were you seeing there that others weren't? Hey everybody, Trey Lockerbie here from We Study Billionaires, and I wanted to tell you about a new company that I absolutely love, and that is called Trade. Trade combines two of my favorite things, coffee and technology. So what you do is you go to drinktrade.com, there's a super simple survey that you take, and then it tells you which coffee they're going to send you that you are literally guaranteed to love. Meaning, if you don't love it, they'll send you a new bag of coffee for free. And from there, you can keep experimenting so you're not falling into the same rut of drinking the same coffee over and over and over again. There are so many different types of roasters, levels of roast, beans from different parts of the world. There's plenty to nerd out on here. So why not be adventurous and try some new stuff? After I took the quiz, they sent me a bag from Sight Glass Coffee in Northern California, and it's literally my favorite coffee of all time. Normally, I've been drinking a coffee where I have to sweeten it with honey and almond milk, but this coffee, I could actually drink it black. It was so delicious just on its own. And right now, Trade is offering subscribers a total of $30 off your first order plus free shipping when you go to drinktrade.com/TIP or click the link in the description below. That's more than 40 cups of coffee for free. Get started by taking the quiz at drinktrade.com/TIP and let Trade find the perfect coffee for you. That's drinktrade.com/TIP for $30 off.
When I met Baiju and Vlad, I was stumbling and bumbling. The Apple iPhone came out in 2007, let's say 2008. And the App Store was an absolute phenomenon, but nothing for finance. In 1999, 2000, you had E-Trade, you had TD Ameritrade, you had Schwab, you had Interactive Brokers, you had Daytech, you had thousands of these like online brokerages, right? Yahoo Finance. You had all the tools that you think you have today, but you had hundreds of brokerages. You had Super Bowl commercials. You had the E-Trade baby. Everybody was blowing their brains out with like 20 minutes delayed quotes, $20 spreads. It was a joke. So then you had the bear market, and it was like taboo to trade. It was like no one can beat the market, even including me. I was like, oh, you got to be nuts to beat the market. And when I saw Twitter in 2007, my whole world changed, and I just felt that was going to be Bloomberg. That was Bloomberg. That was a Bloomberg for everybody. And so I changed my whole philosophy of investing as someone who looks at Twitter just for what I like it for, the markets and goofing off. But like goofing off is not a business. But the markets is 24/7, 365. And if Twitter breaks the news of bin Laden being killed by 20 minutes, right? The future, and this is when I knew this is like game, set, and match. There was somebody in Pakistan that saw a helicopter or whatever, and the futures had moved like 12, 15 points, like 1.5% before the news of Osama being killed, up the market. And that was like proof. There's been 1,000 proof points, plane landing on the Hudson, president tweeting, there's been 1,000 proof points of why, the Twitter is the market, right? Twitter itself doesn't understand how powerful the product is, right? They kumbaya, Arab Spring. They think it's like the management's always overthought what the product was for. And so I knew when Twitter came out that it was all about the stock market. It was all about, and no one was innovative. There was no E-Trade 2.0. There was everything 2.0 except trade it. And that's because Vanguard's just that good, and to be a venture capital business, you got to be 10 times better than the incumbent. Otherwise, people just won't adopt it. Right. And so no one for the aggravation of trading and all the headaches from like the last cycle, no kids were building an E-Trade 2.0. So it really wasn't until 2013 that I got shown Robinhood. I was up in the Valley, and they had pitched me. They had called me because I have StockTwits. I had always been writing about the fact that people should, if the president tweets that the stock market's going to move, and obviously that happened with Trump a lot, but before that I was talking about it. Wouldn't it be interesting if you could buy the shares, click a button on Twitter, and the link would go right to your brokerage account, and you could buy shares and then reshare the trade, the social trading. That was like an 07, 08 idea that I wrote about. And when I saw Robinhood, I was like, finally, it was like a no-brainer to me to do it. I didn't know it'd be worth multi-billions, obviously it was first investor, but I knew that if they build it, they will come. Meaning if Robinhood builds this, couldn't have predicted how big, but I knew if they build it the way they showed it to me, it was going to be massive. And it wasn't about thinking through the business plan or how they're going to make money. It was an $8 million valuation. It was just yes or no. And they delivered on that basic premise. And that's why it was a no-brainer. And I was right. Like, I mean, in the end, I was right. People wanted to blow their brains out. You know what I mean? Like, I can't explain it. But people like the choice. People like to think they can beat the market. And Robinhood provided an on-ramp to tens of millions of people to do it.
I'd like to talk about Howard, the entrepreneur, and I'm going to stick with this kind of Larry David or like Forrest Gumpian kind of a framework, but I know you're way too smart for that, but we're going to play along.
Larry David's really smart. Like,
that's true. Larry David is very smart. Okay, so we're going to stick with the Larry David metaphor here for a minute, because it seems like you kind of stumbled upon StockTwits to a degree. You're on Twitter. You use the $ next to a ticker. What happens next?
So when Jack and Ev, like I said, YouTube came out and my mind was blown. So I'm a hedge fund guy in 2006. I hate my life. I'm trading. I'm not going to win. I'm thinking about what I'm going to do next. And I'm yelling at the TV like everybody who watches CNBC does. They yell at the TV. They go, why is this talking? But you're in a room by yourself. You're literally going insane. And then YouTube came out and I was like, oh my God, this is the future. And I'm going to create, like everybody could create their own CNBC, that was my vision. And at the time, no one will remember this, but in 2006, when YouTube came out, everything was cat videos. People would just put a camera on their cat and take a picture of their cat doing silly things for hours. And that's what people use YouTube for at the beginning, if you can believe it. Oh, and filming illegal content, right? So there were two things they used it for: women filming cats and people filming TV shows and putting them on the internet or whatever they were going to do. And the media companies do what the media companies do, and we were left with cat videos. But I knew that if you could, that's what led me to start Wall Street. Anyway, sell Wall Street, go to CBS, Twitter comes out. And I'm like, that really is the future of trading. And so I dropped everything. I quit CBS and I went to Jack and Ev at Twitter. I said, why don't you guys do Twitter of finance, twitter.finance.com. And they were like, what? We have an open API. You should just build it. And I remember, back then we had Blackberries. We didn't even have iPhones. And I remember Fred Wilson was a friend of mine, and I tweeted him on my Blackberry. I was like, ooh, what do you think of this? I bought Apple, $AAPL. And Fred wrote back a message saying genius. And if Fred writes you back a message saying genius, you're on your way. And I really didn't want to start a company. I was 44. But Twitter didn't want to do it. And so I started StockTwits, which was just Twitter for stocks. And here we are 12 years later. It's got about 1 million daily active users. It's a profitable business. It's a great little business. And it's really just Twitter for stocks. It's just for people who want to talk about stocks. And we came up with the $ as a way to, at the beginning, like if I'm searching for Apple and I go #Apple, it's like, oh, I bought a green apple. Apples suck. I bought a stale apple. Versus, people in stocks talk about, and this is domain experience. For me, I'd spoken tickers. Like I don't know, I'm demented. That's how I saw the world. GOOG, BlackBerry was RIMM, Citibank was C. So the dollar sign was our way of making sure Twitter, we could separate who was talking about stocks versus something else. So that's really, it was just a hack idea that we did.
That kind of raises this question. I mean, Twitter's been in the news a lot lately. They can't seem to make money. I'm curious if the business model with StockTwits is a bit different. Is there anything Twitter could learn from StockTwits about how to make a buck?
Well, they have a lot of cash flow. They also have about 4,000 too many employees. I've been giving out free advice to Twitter on Twitter for about 12 years. No one's listening. But really, if you look at, this goes back to VCs, right? It's not necessarily Twitter's fault. Now Jack hates VCs, blah, 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 blah. Everybody hates everybody. But listen, they made a decision early on to raise bucket loads of cash. When you raise bucket loads of cash, you then have different pressures than you do if you do it yourself. And they had hundreds and millions and billions in the bank, and it came time to make revenue. And trading is a very small business. Even Robinhood has proved that it's very hard to make money. But Twitter should be free for everybody, not even ads. And if they monetize, trading and betting and data from real time, from the people that want to pay for the data, they will pay the most. So if you told Bloomberg tomorrow or Goldman Sachs that if we see someone on Twitter at Goldman Sachs, we're going to sue you, we're going to do a takedown notice, really. So really, Twitter's not charging the right people the right amount of money. So in a right world, Twitter is a pipe, and they should charge JP Morgan, Goldman Sachs, Reuters, hedge funds, Bloomberg, billions of dollars a year, have about 150 employees in a perfect world, and let every company sip from the fire hose and charge accordingly. Then they would have this great utility business. But when you raise billions of dollars, it's very hard to tell your VCs, hey, we're not going to hire any employees, and here's our business model. And so it was just like early mistakes around raising money and expectations that set them on this path. It's a disaster. I mean, it's one of the greatest products of all time, maybe the best. And it's not used by hundreds of millions. It's used by a few hundred million people. It's not YouTube. And so if you look at Bloomberg, which has 150,000 paying subscribers and is a 10 times bigger business than Twitter and is very profitable, if Twitter had done the same thing and just focused on Bloomberg, the company would be worth $150 billion without selling ads. And they didn't know that business. So they didn't see that view. And I'll tell you who's breathing the biggest sigh of relief is Michael Bloomberg, because Twitter could have destroyed him. And instead, he let Bloomberg sip from that fire hose, insert it into the terminal, and now all those hedge fund guys get Twitter. So that's probably the biggest mistake they made, is trying to be something for everybody and not realizing that the best business in the world only has 150,000 paying customers and is a private company.
Let's talk about some of the the pros and cons, the balcony and basement of VC, because you kind of mentioned earlier, illiquidity can be somewhat of a blessing. It's kind of like leverage, though. It can cut both ways. And I'm kind of curious about the name of the fund. Actually, is called Social Leverage. Yeah. What is the difference between social leverage and financial leverage? How would you define the two?
Yeah, so I grew up in the era of financial leverage pre-internet. So you would stack debt. You would just, if you saw something good, you would just lever the hell out of it, whether it was a house, or whether it was a building, or whether it was a mine. Okay, and that was how business was done. Paper on top of paper on top of paper. And it worked fantastic until 2008. Okay, and that was the unwinding. That was when we learned that financial leverage is cool, but when it's your only strategy and it blows, it takes a lot of people down with it. Trump's a master of this. He's done it 7 times. A lot of people have done this hundreds of times. Our U.S. economy did it in 2008, right? It's just this financial leverage. At some point, it all breaks down. Social leverage was my vision, when I saw Twitter, was that you, from your room, could build so much power, right? Look at Elon Musk. Even though he's built the best company in the world, he has no marketing because he can move markets. And so Social leverage is about using your network to get things done. And that's why we can work from home theoretically with all these tools, Slack and Zoom. We're doing this podcast over Zoom. So you have all this social leverage. Obviously, the risk of social leverage is time, because you can get so many things done. You have too many projects, but that's a lot less dangerous than financial leverage, So you may have some more unfulfilled relationships from all this social leverage, and you may spread yourself too thin from all this social leverage, but you're not taking down the whole economy. What takes down the economy and what takes down industries is financial leverage.
Let's talk about relationships. You just brought that up. I mean, over the years, you've built this unbelievable network of brilliant investors and business people, entrepreneurs. Who are some of the people that stand out to you that have made the greatest impact on the way you think?
Yeah, that's a good question. I mean, obviously blogs, right? I was bumbling through life. Didn't have money for Bloomberg Machine. Didn't really trust media back in the day. I was kind of that. Like I said, I was like, I thought everything was rigged. So I acted accordingly. So I didn't have a network. And then, Fred Wilson was blogging. I had searched this term sheet, the word term sheet in Google when I was trying to start Wall Strip and, figuring out how to do a term sheet, because I wasn't a venture capitalist. I was running a hedge fund. And I stumbled upon his blog, and then he had a blog roll. Back in the day, he had a blog roll. And if you landed on someone's blog, you could see the list of people they read. And that was how the web worked. You would just click around. And it was really social. It was really weird. It was a really weird web. And I didn't know who Fred was. And then like 2 months later, I realized one of the best investors in the world, just sharing information for free on his blog. And I'm like, this stuff should be really expensive. So for me, that was like the aha moment, is being able to become friends with one of the best investors in the world just by reading his blog and sharing links and doing all that stuff. So I don't have that many people that I trust, right? I'm more into like comedy and like big ideas and people that think very differently, like Letterman and Jon Stewart and George Carlin back in the day. And from an investor standpoint, Fred Wilson, there's Roger Ehrenberg is a great investor, Brad Feld. They all kind of came up together in the 90s in that first internet boom, and they had those wounds from 2001, right? So they had already been through a cycle, right? And this is what's going to help this next cycle is they're going to, the longer these cycles go, the more mistakes pile up because everybody doesn't know. And now that we have this 2022 crash, there's going to be, listen, it's miserable. And some people are going to get wiped out. Well, they are getting wiped out. But the people that survive will now have battle scars that will be able to mentor the next generation, right? And so luckily for me, when I got into venture capital, there was this like decrepit, destroyed group of VCs, from the 1990 to 2001 that were sharing like their knowledge. And you could trust them because like they had been destroyed and they were building back up. And I think so this next boom ahead will be so much better now that we've kind of cleaned up the riffraff from this long, money boom that went on.
I was just looking for it. I have Brad's book back here. It changed my life on the venture side of things. It's such a fantastic book. It's called How to Be Smarter Than Your VC, I think, something like that.
So Brad, I got lucky to meet him early, and I was early in Techstars, and so he's a mentor and friend. And, when you're around people that successful, right? You don't know they're successful. You're just enjoying, like they're approachable people. And they were in their prime, 15 years ago. We could argue about what prime is in investing. I think I'm too old. I mean, I'm good at it, but you don't see the world the same way as a 25-year-old or a 30-year-old. You can't, because you can't use the products in the same way. But these people understood tech. They had been through a crash. They had seen winners before, right? They'd experienced defeat. I mean, that's who you want to be mentored by. You don't want to be mentored by someone who's only seen victory. I mean, it must be nice, but there's no such person that hasn't had tremendous failure. So it was the right time with the right mentors on the right platform. And then, let's be honest, Web 2, or whatever we want to call it, YouTube, Twitter, LinkedIn, Facebook, came out at the same time within 2-3 years of themselves. So you had to be, and AWS. So you had to be a complete, luckily I'm not as Larry, that goes to the Larry David thing. You could have just shown up in 2007, 2008, 2009. And as long as you didn't blow up, you're going to get rich. And that's where we are. And now a lot of people just think they're smart, but like when you have that many platforms launching at the same time, forget about it.
I'm going to stick on this comedy piece. I find it really interesting. I actually just watched the Carlin documentary, and there's this moment in there where, well, to back up a second, I mean, I like to say that I came to investing for the money, but stayed for the philosophy. A lot of these investors you learn about, they're philosophers to a degree. And in this documentary, you had a Chris Rock at one point being like, nowadays we don't really have many philosophers. We have comedians, or like a lot of people look at comedians almost like philosophers because they're providing some commentary or some view of the world you can't find elsewhere. But then Seinfeld came on and said that, you could look at it that way, but he had never seen a comedian who changed his opinion on anything. So I'm relating that back to you and the relationships you built over time. Where do you kind of stand on it? Are you finding people that really change your way of thinking, or do you kind of look at it and say, I respect that, but I view it differently?
Yeah, I don't. I think one of my gifts or my weaknesses, because people, you don't read enough. And I'm like, I don't know. And then I'm friends with people who read a lot, and they tell me, if you don't like a book, put it down. And Morgan Housel say, put it down in the first 3 pages. Like, what the hell? It's not your duty to finish a book. And I assume most books suck, just like most tweets, most blog posts. So it's like, do the math. You're going to read all your life and have 50 books that stand out. And I'm like, I'm not interested in me. I'll listen to podcasts instead. So, I'm not as well read as the next person. But culturally, I feel like I'm in tune with things because, first of all, I have a silly mentality, born with it, whatever, lucky. Secondly, I have ability to make fun of myself, which is a gift. Some people just can't. They take themselves too seriously. If you look at CNBC, 99.9% of the people are doing it wrong. They can't laugh at themselves. They think they're the experts. If you think you're the expert, believe me, 99% of the people know you're not. So the ability to take a piss on yourself, as Ricky Gervais would say, matters. So comedians, until the woke period or until Twitter came along, kind of were like these respected, they would explode out of nowhere, whether it was the Seinfeld show or all these sitcoms came from stand-up comedians, because these people were like in the street 20 years. They weren't overnight successes, right? Like they had to slowly bubble. So they had this great community. And comedy is two things. There's not like jazz. There's not like soul. There's not like funk. There's funny and not funny. And if you're a funny comedian, whether you're a woman or a person, you were in the club, the Friars Club, right? You were respected because you just made people laugh. And then somewhere around 2000, maybe Obama or after, and then you throw in Trump, and nothing became funny anymore. Everybody was canceled. Comedians were getting canceled. Maybe it was the iPhone, blah, 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 blah. And they were getting pushed around. The culture in America is we need comedians. Like you don't go to Germany for stand-up, right? You don't go to China to watch stand-up comedians. You come to the US, you go to New York or LA, and it's like culture. It's like rock and roll. Until very recently, and Dave Chappelle has been part of the pushback. Netflix has been part of the pushback. Ricky Gervais has been part of the pushback. Comics have been pushed around as if they're like they're responsible for all this. Listen, they're dirty people. They've done stupid things. I'm not saying we should, some of them don't deserve to be canceled, but like their job is jester. And if they're funny, we need to put some of this stuff back in context. So I really look to comedians to really see where we are in the culture. And I think we're entering this period post-COVID as the comedian is finding their voice again. And the comedian community is coming back together and getting a handle on the woke community and the right, and they're getting a handle on how to manage phones as you come into a club. And they're starting to push back against like the cancel culture. And when they start pushing back, when you have people that are that smart and that creative, finally just pushing back, we need more George Carlins. Like we need more Ricky Gervais. They may be rich and they may be affected, but they really have a way with their words of defining moments in time. And so I'm really excited about that's American culture, like having comedians come back. So I'm like, that I think that whole area is very important to me because it's a very strong community.
This is a very contrarian take. I mean, you're seeing the shift and the culture and looking at it as an opportunity, right? You're saying
Yeah.
this is a good setup.
This is one of the best setups for community. And I'm working on a startup right now around this in Web3 or NFTs. But there's certain communities that band together, band of brothers. Stocks are just wacko people that like talking about stocks. Jazz people love talking about jazz. Comedy is more interesting to me because, like I told you earlier, there's not like different styles. You are either funny and accepted or you just suck. And that's just red. That's just black and white. And that's beautiful as an entrepreneur. You combine all the tech, combine all the opportunity, all the globalness of it. And I think the comedy, combined with the fact that COVID's ending, people are going back to clubs, combined with Netflix, combined with just all this talent and all this material from the right, from the woke, from like Twitter. There's so much material to be funny about that I think we're about to have an explosion of creativity.
You mentioned joy earlier, and I know you've thrown this into some of your projects, investing for profit and joy, and the joy really popped out at me. I mean, it seems obvious when you just kind of gloss over it or read it. You say, yeah, you want to make money and be happy, but that word in particular is such a choice word. It's kind of interesting. It's not happiness, it's joy, right? And so I'm kind of curious over your career, which part of investing has brought you the most joy? For example, Warren Buffett says he tap dances to work. He doesn't need any more money, so it's not really that. But is there something in the process, or is it the idea that has come to fruition? What gives you the most joy when you're investing?
Yeah, I mean, like I said, let's frame this that I was born on third base, white, Toronto, middle class, upper middle class. So it's pretty hard to fail. Then you throw in the internet and the cloud and Twitter. And so, you got to be complete putz not to be successful. So all that being equal, I'm not going to, I can't do anything about it. So I can just, use the tools that were given to me. But like, I find I was so miserable, like, because I thought, like, I just didn't know, right? I didn't have mentors, I was doing, I thought an entrepreneur, you run a hedge fund. And so I was just part of the machine instead of like stepping outside of the machine and seeing what you could do. And luckily for me, the internet came along and YouTube. I was just sitting there watching cat videos going, no, they're all using it wrong. This is going to be like incredible, right? And now, when I was young in the 80s, you had to be able, if you were like, and I grew up Jewish, like Jewish community, you had to be a lawyer, doctor, accountant. A lot of pressure. Right. That means you got to do school, you got to go to graduate school, and you got to go bill by the hour. That just was not appealing to me. Right. Today, that's truly what AI is disrupting. Like everybody says, tech's coming for my jobs. Tech's coming for lawyers, doctors, and accountants. Right. Like there's three paragraphs you need in a contract. Right. And let smart contracts will start taking care of that. Doctors, let's be honest, no one trusts their doctor. We didn't trust Dr. Fauci. Now, I'm not saying good doctors aren't good, but like we're open to new ideas. And then accountants, I mean, everything's cash-based account. Like, we've already blown up the idea of what accounting is because everybody can work for themselves and figure out how to be cash flow positive. So in a world like that, people can actually pursue their passion. In a world of TikTok and YouTube and Twitter. So, for example, my kids are not a lawyer, doctor, accountant. My daughter's living in New York as an entrepreneur. My son's living a golf life. And, 30 years ago, that wasn't a choice for any kid. And so that's joy. Like kids, they have other kinds of stress and they have other kinds of, I wouldn't say depression, but anxiety that the phone brings and all these things. But that comes with the territory. But with the smartphone and with the cloud and with the internet comes these unbelievable ways for people at a much younger age to find their calling and to do stuff they love. They'll still screw it up and they'll still make mistakes. But the fact that it took me till my 40s to figure out my calling, if we could help people speed that up and do it in their late 20s, that would do an incredible amount for both behavioral good of the world and just wealth. because that extra 15 years of the grind, if we can get that out of people, is an important kind of message of what I'm trying to do. Is like, and I'm trying to lead by example. A lot of people that read me just go, "Oh, I want to live your life," and I'm like, "Well, if you're going to live it, try and do it in your early 30s. Don't wait till you're 50 like me, because I think it's possible." So what we're trying to do is speed people up so they can get into the career path that they want, and that's what leads to joy. Happiness is a weird word. Anxiety is a word. We all have anxiety. That is just a real word. We throw the word depression around a lot, but anxiety is like real. And I would say 70% of the country has anxiety, whether it's from money or the phone or from family. So the only joy we're going to get is that when we're not doing those three things, which is our work life. And if we hate our work life, we're screwed. So being able to find what you like doing has been a gift. And like showing other people the way is really fun.
Okay, I have a bonus question for you as well here. So, you mentioned NFTs and you're leaning into that world of Web3 moving forward. And I am in my early 30s, and I feel like I'm one of those people that was excited about it to a degree, and then I kept looking into it, following it, and I was like, I just can't find a use case for this. And there's this clip going around with Andreessen kind of fumbling his way through a elevator pitch on Web3, and I guess I've just been around it a long time, and I'm struggling here. I'm struggling for the use case. Can you walk me through or give me a proper one?
Yeah, it's not going to make people happy, but I feel like I finally have an idea of what it is. And that's the problem. If I can't explain it, I'm supposed to be an expert, and I admit that I don't know it, how can you invest in it? So I think this goes to all the money that was going around, right? Like everybody's looking for a new platform, right? If you had started when Google Glass came out, like 2012, like they bury those magazines of Mark Andreessen, et cetera. These are very smart people. I know these people, they invest with me. They're top of the food chain in terms of what they read and how they think, but they're wrong just like everybody else. And when they're wrong, they're really wrong. So if you remember, there was Google Glass. Everybody was going to wear glasses. And that was going to be your search engine and blah, 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 nirvana. And if you had started, and Andreessen did, if you had started a Google Glass fund in 2012, let me tell you, there's a lot of donuts in that fund. Okay, so Web3 feels like Google Glass in that it's just the web. And people have built it into being like, who's going to benefit from Web3? Google, Apple. Why is Warren Buffett buy Apple? Why does he think Bitcoin is silly? I mean, he's soundbiting, but if he really believed it was stupid, he wouldn't have 42% of his money in Apple. Basically, what Warren Buffett's saying is if Web3 is something, Apple will be part of it, right? And it's smart because he's hedged. If 5 years from now saying he's not going to miss the crypto trend because Apple's going to have a wallet, because this whole thing won't work. You and I don't get it because it needs to work with Apple Wallet. And by the way, we need to be able to pay for an NFT with Apple Pay. Like I shouldn't have to go and do Ethereum. So so technology in all its wisdom has complicated this whole thing, which is a feature, which is a beautiful feature. The whole point of Web3 is for it to be complicated so that it's not for everybody. But then the VCs came in there and said, we're going to make this for everybody. Well, 10 years later, it's for nobody except crazy people. So the way I think Web3 is it just augments Web2. Like if you have a Shopify page and you have a great little store, there should be an easier way to build community around your product. And that's where NFTs come in. But an NFT is not really going to work if your 60-year-old cousin's got to download a MetaMask and then transfer $60 into Ethereum and pay $100 for that transaction. No offense to the crypto people, but that's just mathematically dumb and like 8 steps too many when they have an iPhone in their hand. So I think we're going backwards. And I think the way to think about NFTs is the opposite of Web 2.0. So in Web 2.0, the 2 hottest companies were Groupon and like a ClassPass. And the whole idea of Groupon was like, take the whole internet and turn it onto your sandwich store. And Frank, the sandwich guy, could go pay Groupon and have 1 million people show up on his door at the same time. Let me tell you what happened. It happened. And then Frank went out of business because he got all the dregs of society coming for their cheap one-time sandwich. That was the Web 2.0 version of NFTs, Groupon and ClassPass and flash sales. It was magnificent. From an entrepreneur's perspective, I could channel everybody on the internet and make them go to one place at the same time. Unbelievable. Web 3 is the opposite. If I could send you the best people at the right time with the right way to enter the club with my NFT, and there were rewards built into that so that the right people are using your product and they can form community around that, that's Web 3. What everybody's got wrong is they think it's the same as Web 2. And Web 2 is about traffic. Web 3 is much more about the right traffic. And so I think it's more of a extra feature of the web. And that's why we're having no one's having that real discussion, but Groupon was a very Web 2.0 thing. And that didn't work. I mean, it worked for the founders of Groupon, but it needs to work for the Frank Sandwich Shop. And I think Frank's Sandwich Shop needs this to work with Apple Pay. And he needs to be able to give out a card that nobody loses for loyalty that's just an NFT. And that NFT can do many more things for that customer, right? The more information you plug into your NFT, the more information that you could help your customer when they come in the door. So I don't think it's as big as what everybody says. But at the same time, the companies that are going to now build using NFTs are going to be better. And I think Apple and Google are probably the biggest beneficiaries of it.
Well, in the spirit of this discussion, I will end with a Carlin quote that kind of ties in what you said. I think what I'm hearing is you're saying it's kind of like, as he would put it, the words alter and change. You can alter your pants or you can change your pants. You can alter your plans or change your plans. It's just, it's funny how I think you're saying there is that Web3 will alter Web 2, not necessarily change it. So, Howard, this has been
YouTube altered the first web, and Web 3, which will probably be Apple Pay and Google Pay, and maybe a few other wallets, that will alter Web 3.
Howard, this has been so much fun. Thank you so much for taking the time. I've really enjoyed it. I like I said at the top, I'm so impressed with everything you've done, and it takes a certain, a flexibility, elasticity, something that to kind of keep your mind as open as you have to play all these different roles and to fit into all these different scenarios and or opportunities. So a lot to learn from. Thank you for putting out a lot of content on it as well. I highly recommend people check it out. Before I let you go, please hand off to the audience where they can learn more about you, find your podcast, find your research, anything else you want to share.
Yeah, three things. Thank you. HowardLindzon.com, my name, just search it. I write pretty much every day. It's about the markets, trends, my prostate, my family. And then Twitter is generally the silly dissident Howard, which is, can I get kicked off the internet? I'm trying to, it's a fine line between getting kicked off and not. So, it's definitely a more edgy part of me. And then my podcast is just lean back with my buddy Knut. We've done, 300 episodes called Panic with Friends. You can search it on Spotify or Apple. And I sit down with my favorite entrepreneurs, the people I look up to. And I don't ask them, you've run a professional interview. I literally do not run a professional interview. It's a mix between how Conan O'Brien, he talks about himself all the time. I kind of do that. It's hard to get me to shut up, but it's really just a wacky look into how I think about things and trends. And that's one a week called Panic with Friends.
Fantastic. Howard, thank you so much again. Let's do it again.
Thank you. Great to meet you.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.